Liquidity risk. Now, liquidity is a basic concept that if you've been around for any amount of time, you're well aware of. But it's one of those concepts that new traders and new investors oftentimes ignore. It's not a sexy concept. It's not a terribly exciting concept, but it's critical to understand what liquidity is and the risk associated with it. All liquidity is, at the end of the day, is the ability to easily move in and out of positions. So if something has high liquidity, you're able to enter a position, exit the position with relative ease. If something has low liquidity, the opposite is true. It's harder to get in and out of that position. Now, this can have dire consequences on a couple of different things. One is the bid-ask spread, whether a stock or a Forex trade. That bid-ask on a highly liquid, something that has high liquidity, is going to be very narrow, which means we don't have to pay as much. There's not as many transaction costs. But if something has low liquidity, then your bid-ask spread will be much wider. You'll have more transaction cost. And that's annoying. And over time, that can really affect your bottom line. But for stock investors or option traders, liquidity can be a nightmare. If you find some obscure stock to trade, and let's say you buy a lot of out-of-the-money options on that stock, and it has real low liquidity. And let's say things go well for you. Well, you're going to have a hard time moving out of those positions at the price you want. You're going to have to give back a lot of the profits you've made just exiting the position. And here's the thing, there's no reason for any of this. There are tens of thousands of stocks, ETFs, indexes around the world to trade. There are some awesome currency pairs in Forex to trade. Why spend your time on things with low liquidity, that have low volume associated with them? You only have so much time in the day. Your eyes can only look at so many charts. This is why many Forex traders simply trade the big pairs, the major pairs. They're highly liquid. Euro dollar, pound dollar, dollar yen. These are highly liquid pairs. And you can make all the profits and all of the rules apply. When you're trading stocks, stick with the ones with high volume, because liquidity and volume go hand in hand. Stocks that have 1 million shares traded on them a day, or at least 500,000. So you can easily get in and out of your positions. So you have low transaction costs, and you don't face some of the nightmares that some traders have to face. There's just no reason for it. So let's be smart with our time management. Let's focus on the major pairs, highly liquid pairs, highly liquid stocks, and build our daily routine watching and following the price movement on those. Liquidity risk is a problem that you absolutely don't ever have to face if you're just smart about it. There's no reason to not focus in on the highly liquid pairs, the highly liquid stocks. There's just no reason.